Hey business warriors, Business Shifu here, and today we're explaining the concept of dollar cost averaging. And this is a concept that everyone who deals with the stock market, buying stocks, shares, ETFs, funds, whatever, should know, okay? And let's talk about how it works. So obviously in the US here, it's called dollar cost averaging. In Britain, it would be called pound cost averaging. You can also call it unit cost averaging, or if whatever country you live in, you can just replace the first word with your currency, Indian rupee cost averaging, whatever, wherever you're from. And so basically what it is that as stocks trend upwards, okay, the market does trend upwards. Sometimes there are corrections and it dips down, or large recession like 2008, but in general, it trends upwards. So if you always buy in the same amount of money into that fund or that market or that particular stock every month, sometimes you'll buy it at a high price, at an overvalued price when people have bid the price up because of some positive news about that stock or fund or whatever, and sometimes you'll buy at a lower price. But you are always spending the exact same amount of money, so you end up buying when you buy it at a lower price, you'll get more shares for your money. So you end up having bought more shares at a lower price, and that lowers your overall average cost of your shares and gives you good value, okay, as it trends up. Basically, as you do it for a longer and longer period of time, let's say over a year, every month, you end up having got quite good average value for the shares. Whereas if you had invested, a lump sum or whatever, chances are you may have bought it at a time when it's overvalued, okay? Now, dollar cost averaging is not a magic thing that if you do it, you always get good value for your shares. If you have a lump sum and the market is trending upwards, it would actually be better just to put your lump sum in straight away because the market's trending up. So in the future, even if it's got dips and peaks, you know that on average it's actually going to be higher priced than the price of those stocks now, okay? However, if the market is trending downwards, dollar cost averaging can be a very good way to do it because you don't know where the bottom of the market is, okay, or the bottom for that particular stock is. So let's say you have, $100,000 to invest as a lump sum, but the market's trending down, you might as well dollar cost average your way in, let's say $10,000 a month, so that you test it and say 1 month, $10,000 go in. After the next month, the market's still going down, you get another $10,000 worth of stocks at an even better price, even lower price, and you just keep going down, and then eventually it'll start coming back up, and you'll end up with, maybe not the price at the bottom, but a good average price. And we'll have a look at that with an individual stock as well. So dollar cost averaging is sometimes, a lot of people use it. I personally do this as well. People use it for buying in and selling out of stocks because it's hard to know where the bottom is and where the peak is, okay? So let's talk about buying into a stock first. Let's say you have looked at a company, it's a solid company, their balance sheet is good, EPS is good, PE ratio, etc. But there's been some negative news about it which has caused the stock price to start going down. You think that you're looking for a bottom, you think you're close to the bottom, but it's very, very hard to really find a bottom on any of these stocks, okay? People have been talking about finding a bottom with GE for the last year, and it's just kept going down. So it's very hard to find a bottom unless you're like psychic or something, right? Which most people aren't. So you can dollar cost your average way in. So let's say you had $10,000 to invest. We'll just talk about a fictitious stock. So let's say the price of this stock is $150 per share. So on the first day, you buy $2,500 worth. Then after a few days, the price goes down to $148. So you buy another $2,500. Then after a few more days, the price goes down to $145. You buy $2,500 more. And then perhaps there's some positive news and it starts to shoot up and it goes up to $149, and you put the rest of your money in another $2,500. Because you averaged it out while the stock was still going down, you got a better price on average per share, $148, than if you had just put it all in on the first day at $150. So that's basically the way to do it in buying a stock. When you sell out of a stock, you can also use the dollar cost averaging method to mitigate some risk because you don't really know where the true peak is, okay? So you might think you're at the peak, but you really have no way of knowing. Anything could happen, they could suddenly strike a deal with another company that's going to bring in a lot of profit, and there's a press release about that, and that causes the stock to shoot up even higher, okay? Or the opposite could happen. So you use the same method. You think you've hit the peak, so you sell out you know, maybe a quarter of your investment, if it's $10,000, $2,500, and then you wait a few more days, you sell out more and sell out more. Obviously, if you were right on the first day and you really had hit the peak and then it started to drop, you would have been better off just selling all of your stock on day one. So dollar cost averaging isn't some magical way of always earning more money or getting a better price than if you did a lump sum sale or purchase. And it has actually attracted criticism from some economists saying that it's just a gimmick or whatever. I personally don't think it's a gimmick, but it is important to understand that it's not like a, you know, magic pill, and you can actually sometimes be worse off doing dollar cost averaging than you would have been just doing lump sum. But it is a way at managing risk, okay, when you're buying in and out of stocks, or also a way of getting your average price of stock a little bit lower when you're doing monthly investments, that you get the money per month, you know, so you're getting, say, money from a salary from a job and you only get it that month, and then you always buy the same stock every day each month, and on average you get a little bit better value for it. So guys, that's the concept of dollar cost averaging. There are also several other ways of doing it, like buying the dips, which is something we'll talk about in another video. Guys, I'm thinking of setting up a trading account that we're going to use for this show, where we can test out various stock market strategies and show the results. Our first one will probably be dollar cost averaging, and then we'll try buying the dips, and we'll try some other strategies with different stocks, and we can show everyone the results. It'll be public, you'll be able to see it. So give this video a like or leave a comment if you think that is a good idea. We'll probably be doing that within the next month or so, so just let us know what you think. As always, please subscribe to the Business Shifu. We will have more business, entrepreneurship, and investing videos coming out at least twice a week. Give this video a like, and we'll see you next time. Bye-bye.